Tired? All right, go. Yeah. Oh, I don't know. On for 2 weeks. I was off quite a bit of that, but I was able to get our dogs, 5 of them, to like lay in the room quietly until about 7:30. My wife back in, they're back to 5:30. 5:30. As soon as she hears them stir, she just gets up and feeds them as horses, and they're running and jumping. And I'm like, oh, you're not doing what I did. No,
It's just like when Andy's home, or he knows.
yeah.
Oh, he's kind of running that.
Ready when you are.
All right, if it pleases the group, we will go ahead and proceed with the opening of the meeting for the Finance and Audit Committee for the Sacramento Metropolitan Fire District, Thursday, January 25th. At this, do we need to call a roll? You're good.
We're good. This evening we have Director Clark here as the alternate. I'll just mention that.
All right. Public opportunity to discuss matters of public interest within the committee's scope, including items on or not on the agenda. Do you have any?
I do not have any speakers.
All right. Moving on to the consent items. Any questions from board members?
I would move that we approve the consent agenda. Second.
We have a motion and a second. Seeing no questions, all those in favor signify by saying aye.
Aye.
Those opposed? The ayes have it. Moving on to action items. Election of officers. So wait a minute. Who's not here? Ted Wood. Okay.
I'll third that nomination.
All right. All kidding aside, is there anybody that has a burning desire to be chair of this committee?
Not me. I am good as an alternate right now.
All right. Director Rosali?
Yes.
Yes, what?
Yeah, that's what was the question. Do I have a burning desire to be chair of the committee?
Or do you have any suggestions?
I nominate Director Wood.
I second it.
All right, then. In consideration of Director Wood.
Yes.
And the fact that he is not absent or that he is not present to accept the nomination, can we table this item? I'd like Director Wood to be able to have some input whether or not his schedule would permit him to participate as the chairman.
We can table it for the next meeting, and then I assume you'll run this meeting as the chair.
That works.
Sounds great.
All right. So action items will be tabled. Presentation items. Ms. Thomas, would you please?
Good evening, directors. Amanda Thomas, Chief Financial Officer. This evening for the committee, I will be presenting the results of the annual valuation reports that are done by CALPERS for our pension plans that we have with CALPERS. These valuation reports are as of June 30th, 2016, and they will impact our contributions beginning with the fiscal year 18-19. So just an overview of what I plan to discuss this evening. We'll talk about, in general, the plans, the CalPERS plans that we have. I'll give you a little bit of background on actuarial methods and terminology, so some of the rest of the presentation might make a little bit more sense. And then I'll talk about the specific results of those valuations as of June 30, 2016, which again, as I mentioned, will impact our contributions beginning next fiscal year, so the fiscal year that starts July 1, 2018. And then at the very end, I'll discuss the reduction of the discount rate, which is the assumed rate of investment return. We did talk about this when I presented the results for June 30, 2015, but this is just kind of more of a reminder, and we have a little bit of better information about what the impact to our contributions will be, and those will be phased in over the 2018-19 through 2024-25 contribution years. Just to provide some context at the outset, this chart is showing us total district long-term liabilities as of June 30, 2017. So of our total long-term liabilities of about $583 million, you can see that the net pension liability represented just under $400 million of that. So it's obviously really significant when we're talking about district liabilities. The summary of the plans that we have with CalPERS. So we have the safety plan, which, as you can see off to the right there, represents the largest share. Either if we look in terms of total members or total liability, that's by far the largest share for us. And then within that plan, we have members who are either earning a classic benefit or a PEPRA benefit. So the maximum classic benefit is 3% at age 50. The maximum PEPRA benefit is 2.7% at age 57. And just as a reminder, PEPRA is Public Employees Pension Reform Act, and that applies to any members who joined the system after January 1st, 2013. Then we also have a miscellaneous plan for non-safety members, and in the classic miscellaneous plan, the benefit is 3% at age 60. In the PEPRA miscellaneous plan, so for miscellaneous, we actually have separate plans for classic and PEPRA. That benefit is 2% at age 62. So, looking at those benefits, how does CalPERS determine what the benefits will cost and how the district is required to fund them? They do that by using something called the entry age normal cost method, where projected benefits are determined for all the members, and then the liabilities associated with those benefits are spread to produce level annual cost as a percentage of pay every year from age of hire to age of assumed retirement age. So what that looks like is just taking a hypothetical person not in our plan, but just as an example, a 49-year-old employee who started at age 25 and is assumed to retire at age 55. The blue line here is going to represent what we call the normal cost contributions, and these are cumulative contributions over the working years of that employee, both employer and employee contributions, but that's what needs to be put aside in terms of contributions. Then we're going to add to that what you see here in red, which are the accumulated investment earnings on these contributions over that same period of time. So that when we get to age 55, which is our assumed retirement age, the total size of that bar represents the projected benefit. And that's what we need to have in the bank when that employee retires in order to fund their retirement benefit over their retirement. So that's a projected benefit. You'll hear me talk about actuarial accrued liability, and you see that pointed out there because we are assuming that right now we're in the year where that employee is 49 years old. So as of that year, the liability associated with that employee, or the actuarial accrued liability, is represented by that bar at age 49. And it's basically the total cost of the benefit the employee has earned as of the valuation date. So I've kind of thrown in some of these actuarial terms, but just to define a little bit more what they mean. The normal cost is the annual cost associated with the upcoming year of service accrual, or in other words, it's the cost of the benefit being earned in the current year. The actuarial accrued liability is the cost of all benefits that have already been earned. And then the market value of assets is the total savings or the total amount that's, again, sort of in the bank as of that date. So that would be cumulative contributions plus cumulative investment earnings up to that date. And then the unfunded actuarial accrued liability is going to be that market value of assets minus the actuarial accrued liability. So how much do we have minus what we owe? Because our contribution amounts are based on assumptions that aren't always realized, that's what creates that unfunded liability that I talked about. Because it seems like if we're always funding the normal cost every year, which is how much we need to fund the cost of that benefit, we shouldn't have a liability. But the reality is that the amount that we fund is based on assumptions about what's going to happen, and those assumptions aren't always realized. So the assumptions basically fall into two categories. They're demographic assumptions and economic assumptions. The demographic assumptions relate to, how long is an employee going to work, how long are they going to live after retirement, and assumptions regarding disability retirements. Economic assumptions are salary growth and inflation, both of which are going to impact the value of the benefit. And then probably the most significant assumption on this page is that assumed investment return. And I actually meant to point this out, but if we go back and look, oops, I'm going the wrong way. If we go back and look at this chart, you can see that, in that last bar there, which is showing us our projected benefit, you can see that most of that is being funded with investment earnings. The red portion is a lot bigger than the blue portion. So how much is actually earned really impacts what we have available. Okay, so more specifically, how does CalPERS determine annually what we need to fund? Well, so the annual funding requirement for each of our plans each year is the sum of the normal cost, so the amount that needs to be contributed to fund the benefit being earned in that year, plus an amortization payment on the unfunded liability. And think of that amortization payment as sort of being like a mortgage payment. So every year that an unfunded liability is created, it gets amortized over a period of time, and we're making a payment towards that. So for gains or losses in a year, those are amortized over a 30-year period, so that's like a 30-year mortgage, except not on a level basis. There's a 5-year ramp up and a 5-year ramp down. So that's what it looks like. Every year a liability is created. You can see that in the first year that we're paying that off, we're paying only a portion of what the actual level payment would be, and that ramps up over the first 5 years. And then although it doesn't look flat on this chart because we're showing this in terms of dollars, it would be a level percent of payroll thereafter. So it's going to increase every year as payroll increases, but a level percent of payroll in the middle 20 years, and then it ramps down the last 5 years. So this is kind of important because what happens is the year after we have a negative impact, we're only seeing a portion of that negative impact, and we're seeing more of it the second year, more the third year, more the fourth year, more the fifth year, which is why you sort of see contributions increasing over time. This is part of what's contributing to that. And then changes in actuarial methods or assumptions or plan amendments are amortized over 20 years as opposed to 30 years. Okay, so that's enough of actuarial methodology and terminology. This is showing us the actual results of the June 30, 2016 valuations, kind of looking at the overall results by plan. And you can see for the safety miscellaneous and PEPRA miscellaneous, the first line is giving us the present value of projected benefits. So that's all benefits that will be earned. The second line, actuarial accrued liability. So again, that's the cost of all the benefits earned to date. As of June 30, 2016, what is the liability based on what's been earned as of that date? The market value of assets is giving us, what do we have in the bank to fund that liability? And then the difference between those two, so between the liability and the assets, is giving us our unfunded liability. So you can see for the safety plan, the unfunded liability as of June 30, 2016 was about $374 million, about $14 million for the miscellaneous, and a very small amount, about $19,000 for the PEPRA miscellaneous plan. When you take the market value of assets and divide it by the liability, that's giving you the funded ratio, which kind of indicates the funded status of the plan. So for safety, we're at 64.7, about 75% for miscellaneous, and almost 90% for the PEPRA miscellaneous. So once we've figure out what those liabilities are and what the costs are that need to be funded and what the contributions should be, those get split among the employee and the employer. So I'm going to first talk about how the employee contributions work. For classic safety employees, there's a 9% employee rate, and then district classic safety employees also contribute an additional 3% cost share. So that's effectively 3% of the share that otherwise would be paid by the district. So that reduces the amount that we actually pay, but it's not considered in the valuation results. So it's not really reflected in the numbers. And you see in the CALPERS reports and a lot of what I'm going to be talking about here. But I will point out where it's been factored in. But in general, it's not going to impact the valuation results. It just impacts how the contributions get paid. Classic miscellaneous employees pay 8% of payroll as an employee contribution, and then all PEPRA employees by law pay 50% of the normal cost rate. So whatever the rate is, the percentage of payroll that needs to be contributed to fund the normal cost, the employee is paying half of that. So for safety employees, that works out to 10.5%, and for miscellaneous, it's 6.75%. So this chart is showing, based on the valuation results, what the employer contributions are, and that's basically the total funding requirement minus the employee contributions, again, not accounting for that 3% cost share. And you can see really pretty much every line here that we had an increase from 17-18 to 18-19. The biggest factors contributing to that increase are the sort of compounding amortization of unfunded liabilities, including the fact that for the year that we were looking at, there was the investment return didn't meet expectation. And then also you have on top of that the assumed reduction in investment return going forward, so the reduction in the discount rate that I'll talk about a little bit later on. Yes, Director Kelly.
That one?
Yeah.
When you were talking about that the employee was responsible for 50% of the total contribution, and then you said that works out to 10.5%.
So it's 50% of the normal cost contribution.
Cost, right.
So it excludes unfunded liability, and it is the normal cost for a PEPRA benefit. So we have a safety plan that includes both classic and PEPRA employees. So the overall blended normal cost for that plan is higher than what the normal cost for a PEPRA benefit is, because that's a less costly benefit to fund than the classic one. So CalPERS does this theoretical calculation where they basically say, if everybody in the plan was getting a PEPRA benefit, what would the normal cost be? And then they take 50% of that, which is the required PEPRA contribution.
When you mention 10.5%, is that of that employee's salary?
Yes. So, and I should have clarified that earlier. So when I'm talking about percentages here, it's basically a percentage of covered payroll. It's a percentage of all of the compensation that would be considered in determining what the benefit would be. So some elements of compensation are what we call non-PERSable. They're not going to be factored into the benefit, and you don't contribute based on those elements. But like overtime is a good example of that. But this is a percentage. So when I say normal cost rate or even effective total rate on this chart, that's a percentage of all of the PERSable compensation.
Thank you.
Director Arzali.
So if you, just to follow that, with a PEPRA employee, you'd have 10.5% of that salary would be allocated towards this benefit. Is that right?
Right, so that's what the employee is contributing?
Exactly. And
Correct.
so then the district is contributing another 10.5%.
Right, in terms of normal cost, and then the district is also responsible for 100% of the unfunded liability contribution.
Okay, thank you.
So this chart just gives a little bit of history. You know, we're talking about normal cost versus unfunded, and this is looking just at the safety plan. You can see that the normal cost, again, as a percentage of payroll, has pretty consistently been between 17 and 18%, you know, since 2007-8. If you look at the last 2 years, it is going up from 17-18 to 18-19. That's really the result of that assumed reduction in future investment return, but it's still, you know, in that 18% range. However, when you look at the unfunded rate, so the percentage of payroll that needs to be contributed to make the required contribution on the unfunded liability, you can see that that's where the increase has been over time. To where 18-19, if you looked at a combined effective rate, we're close to 50%. And I should point out that prior to this fiscal year, CalPERS had us fund both the normal cost and the unfunded as a percentage of payroll. Beginning this fiscal year, we actually pay the unfunded as a fixed dollar amount because it's not really related to current year payroll. It's really a payment on an amount that's owed. So these rates that I'm showing are really just calculated as effective rates. I'm taking that dollar amount and dividing it by the payroll when in reality we're paying it as a fixed dollar amount. But I think for comparison purposes, it makes it easier to see how the two relate to each other. So some of the reason for, you know, why we've seen that increase in the unfunded rate, why these unfunded liability bases have been created is because of what's actually happened with investment returns. So you see that 7.5% dashed blue line, that's the assumed rate of return or the discount rate, and you can see that the actual returns have been volatile, and that in you know the 2008, 2009, particularly 2009, there were big losses that really we're still seeing the impacts on because of how that amortization works. And then again, look in 2015-16, although those are positive returns, they're much lower than the assumed 7.5%. So I think 2016 was a 0.6% return, which is basically like, you know, a 7% loss, essentially, if you're assuming you're going to get 7.5%. So in December 2016, so a little over a year ago, the CalPERS board did vote to lower the discount rate, so that assumed rate of future return, from 7.5% to 7%. And that assumption is phased in over 3 years. So for the valuation that I've been talking about, this June 30, 2016 valuation, the assumption that was used was 7.375%. When they do the next valuation, they'll use a 7.25%, and then the one after that, 7%. So that's what I mean when I say that's phased in over 3 years. But if you remember back to that chart in terms of how those unfunded liabilities are amortized, we have a 5-year ramp up. So that last reduction from 7.25 to 7%, we're actually going to see the impact of that over a 5-year period beyond the 3 that we're talking about. So really, we're going to see increases each year as a result of this through 2024-25 until it's fully reflected in the valuation results. So why did CalPERS reduce the discount rate? Well, these are the reasons that they've given: to strengthen the long-term sustainability of the fund, to reduce negative cash flows by resulting in additional contributions, to reduce the long-term probability of funded ratios falling to undesirable levels. So we talked a little bit earlier about our funded ratios. If we're contributing more, that should help boost up the funded ratios. Improving the likelihood of investments actually earning the assumed rate of return, and then reducing the risk of future contribution increases resulting from volatile investment markets. So if, you know, the assumptions and the actual results are more closely realized, then there should be less volatility in future contributions. This is just kind of a really simple chart that I know I've shown you before. Don't really pay too much attention to the numbers because they're not specific to us and they're probably not up to date anymore either. But the point is really, if we have to fund a fixed benefit, which in this case is this dollar bill, and we now know less of it is coming from the investment earnings, that side is going to shrink, and that means that the other side of it needs to increase. It just means less investment earnings, same benefit, more contributions. And this is kind of what it's going to look like for us. So these are projections going out through 2024-25 based on what CalPERS has told us in terms of their projections of the impact of the discount rate reduction as they've assumed it, as they plan to phase it in, plus all the other assumptions that they've made in the valuations. And you can see that basically over the next 4 years we'll have about a $4 million increase in contributions each year, and by 2024-25, our annual contribution will be approximately $50 million. This does take into account the 3% employee cost share, and it also assumes that we'll have increasing percentage of PEPRA employees over time in our safety plan, which CalPERS does not make that assumption. So their projections are a little bit conservative for that reason. So this factors both of those in, and with both of those assumptions, you can see that that the increase in contributions will certainly be presenting some challenges for us from a budget standpoint. So you can be expecting to hear more about this when we're talking about preliminary budget and looking at 5-year financial forecasts as we go forward and look at our budgets. And that concludes my presentation, but I would be happy to take any additional questions you have.
Are there any questions on the CalPERS annual valuations?
Only one. Going back to the projection that at the point of retirement, the individual has $1 million in the account.
All right.
Am I making sense so far?
You are. I'm just trying to find the chart.
Okay.
This
So,
one.
Question then is, what is the expected rate of return on that $1 million to fund that individual's retirement? Is that a fair question?
That is a fair question. So basically, there's one assumed rate of return, but at any given time, there's one assumed rate of return. So as of today, the assumed rate of return is 7.375%, whatever I said it was. It's going to go down to 7.25, and then it's going to go down to 7, and that will be the assumed rate of return.
Okay.
Does that make sense?
Yeah.
Okay.
All right. Thank you.
Any other comments? No? Ms. Thomas, thank you very much.
Okay. Thank you.
At this time, next meeting to be determined, do you have a date in mind?
No, I'd like to talk to the committee and determine if we want to meet in February. It might not be our regular meeting date. There might be a need for a special meeting, or we can wait until March for another meeting.
All right. Okay, then, any anticipated items to be discussed at future meetings? Seeing none? All right, then. We will adjourn the Finance and Audit Committee meeting.